Well, good morning, folks. I'm delighted that you came out this morning to listen to what I've got to teach you about how to avoid getting crushed in the next bear market. I'm only going to talk to you about stocks and ETFs. I don't do annuities. I don't do insurance. I don't do any of these. I don't do futures. I don't do Forex. I just do stocks and ETFs. I'm a money manager. I'm going to get into some detail about that. And I'm going to show you exactly how I go about managing my clients' money. Most of you are probably self-directed, and that's great. I hope that what I can impart to you is some of the elements that I have learned to avoid losing a lot of money in a bear market and capitalizing on a bull market. Those two elements are extremely important. Whether you're managing the money yourself or you have a money manager, that's what you want to have happen. Let me tell you a little bit about me. I'm the president of the company, Turner Capital Investments. The company has been in business since 2008. I have been involved in the financial world since about 2000. My background is engineering, computer science, and finance. I built a system and sold it in the mid-90s. A company I'd built and had run it for nearly 2 decades. We built enterprise-level software systems for the pharmaceutical research world. And at that time, I had just about every major pharmaceutical as a client of mine in the world. I had most of the research universities in the United States as clients. Our biggest competitor was Oracle. So we were really in the process of methodology of providing the enterprise-level software systems. I'll give you that information only to tell you a little bit about my background. I sold that in the mid-90s. I had money for the first time. And so I did the smart thing. You know, when you have money for the first time, you want to do the smart thing, right? Well, the smart thing I did was to put my money with a big Wall Street firm, well-known, big-time Wall Street firm. It took them about 2.5 years to lose my life's work. Now, hopefully that's never happened to you, but that is a devastating thing to have happen. And I went from semi-retired to not so much. And so I fired them 2.5 years too late. I decided I couldn't lose money any worse than they did. I started coming to some of these shows. I began looking for software tools to do a lot of the heavy lifting for me. I knew that with my background in computer science, I didn't have the time. No individual has the time to go out and research thousands and thousands of stocks and find the 1 or the 2 or the 5 or the 10 that you're going to put money into. I wanted to have a computer system to do that. Well, I couldn't find anything that I liked at that time. This was in 1997, 98, 99, that period of time. So with my background in computer science, I decided I was going to build my own system. I still had programmers I had access to, and I began doing that. I based it on a lot of research that I was doing. I devoted my life at that point to really finding out how the market works and what I could do to build a system that would help me build my life's savings back up. Something that I thought that would take me, 6 or 7 months, took me about 3 years. And it initially was just a technical analysis. And I began trading in the stock market and began making my money back, and did make it back. And about 2002, it was doing so well, and people were seeing what I was doing, and they wanted to have access to it. I thought, well, I've got another company here. So I formed a company at that time that would provide those tools to the public, and people could subscribe to them, and all that, and that's still there. That company's still running. But I found out pretty quickly that just a technical analysis was not enough. I needed to have a fundamental analysis as well, because technical analysis will give you lots and lots of buy signals or lots and lots of sell signals, but that they don't tell you which one. You know, the charts can all look very similar, but they don't tell you which one. I needed some other qualitative component to that. So about 2004, thereabouts, I began adding a fundamental analysis to my methodology. That really helped. It allowed me to take the universe of stocks out there and move it down to only the ones that had the best fundamentals, and then I would do a technical analysis of those and pick the best of the best fundamental stock that had the best technical trends that were in place at that time. That was working great. That improved the product. I got more subscribers. Things were going well. And then about 2007, people started coming to me and saying, I'd be at these shows, I'd be having my tools there, and they'd come up, they'd say, Mike, I love the tools. but I don't want to do the work. I want you to manage the money for me. And I said, well, I can't do that. And they said, why not? I said, well, I'm not licensed to do that. You have to be licensed to be able to manage money for people. And I didn't want to do that. I didn't want to go back and learn how to do all the stuff that money managers do. I didn't want to take tests. I was far enough along in my career that I just didn't want to go back and do all that. But I have a flaw. And that flaw is I'm a serial entrepreneur. And when people come to you saying, I want to give you business, it's very hard to turn that down. So I said, all right, I'm going to open up a money management business. So I got licensed, did all the studies, took the test, that sort of thing. And so in 2008, probably the best year to start a money management business in all of history, January of 2008, I started Turner Capital Investments. And of course, 2008 was a horrible year. Market down nearly 50%, and we did pretty good. We did what I don't like other money managers to tell you. We did what I don't like other money managers to tell you, which is we really beat the market. Now, beating the market in a bull cycle is a really good thing. Beating the market in a bear cycle may not be a good thing at all. If you have a money manager, or even if you're managing the money yourself and you say, okay, my goal is to beat the market, that's fine in a bull market. Your goal should be to be profitable in a bear market. Because if the market goes down 50% and your money manager's managing your money goes down 45%, what did they do? They beat the market, right? They did what their objective was. And you're down 45%. Okay? So when you look for, or when you have your own mindset around what your objective is beat the market in a bull cycle, be profitable in a bear cycle, or at least preserve capital. Okay? Well, we were down about 4% in 2008. Not bad, but we didn't beat the market. We beat the market. We weren't profitable. I was profitable all the way up until the second week in December. And it went down at that point. So time went along, long story short, hopefully. And about 2 years later, Bloomberg came to me. They saw me make a presentation, and they said, wow, that's the greatest technology they'd ever seen. We have a forecasting component that uses time cycles and all this sort of thing to forecast what any stock or any sector is going to do over the next 90 days. It's an amazing mathematical model. So they saw it, and they said, the gentleman came up to me in New York when I was doing a presentation, and he says, I'm with Bloomberg, and he says, that's the most amazing technology I have ever seen in my life. I want you to put that technology on the Bloomberg terminals. We have 330,000 of them worldwide. I want everybody out there that's a Bloomberg terminal user to have access to that technology. I said, great opportunity, right? Great opportunity, and it was. But that took 2 years out of my life to make that jump. So now let's fast forward to about 2013, 2012, 2013. We're doing pretty good, but not as good as I'd like. We ran into this problem, and I'm sure that some of you have experienced this. You do all the right research. You find exactly the right stock, the right technicals the trends are all in place, the sector's right, the industry's right, everything is right. And you buy that stock and the market falls off and that stock plummets. That's probably never happened to you, but it happened to me more than once. Okay? And so I said to my team, I said, I'm really getting tired of that. Because all we're doing is we're looking at the fundamentals of a stock and the technicals of a stock, and we're ignoring what the market's doing. I said, I want to modify our methodology to include the market. So we went to work doing that. And we ran literally hundreds of thousands of back tests, millions of simulated trades. And we discovered that you could indeed set a bias or find a bias of how to be in the market based on what the market was telling you. Not what it was forecasting, but what it was telling you. And that's what I'm going to take you through today. How to do that. These are the 3 steps I'm going to take you through to make that makes this all happen. So I've talked about that. I talked about 2002 when I started. Talked about managing money in 2008. And then Bloomberg came along. And then the summary is basically this. I started trading this or using this methodology in middle of 2014. We have made a number of very important tweaks to that methodology over the last year and a half, and I'm going to show you exactly how it works here in just a minute. So what makes us different? We're market directional. We do not believe in the worst investment system that has ever been devised by a human being. Buy and hold. Now, I know some of you believe in that, and I'm not meaning to be the least bit insulting when I say that. But I'm going to show you why buy and hold can significantly hurt you. Okay, and why it can be very, very bad for your capital and your financial future. We only invest client assets in the stock market. We're not afraid to move clients to cash. You know, a lot of money managers, they're set up, they have rules where they can't go to cash. I can go to 100% cash. I might do it on Friday. So let me ask you a question. How many of you think that the market right now is in a bull bias? Wow, one hand, two hands. Impressive. How many of you think it's in a bear bias? Okay. Okay. And how many of you just don't have a clue? Okay. Some of you answered 3 times. I'm not quite sure. I'm not quite sure about your financial situation. All right. I know exactly where the market is. Exactly. Okay. It is. I'll tell you about that in a minute. Okay. We know how to capitalize on bull markets, neutral markets, and bear markets. We're not buy and hold. And I'm not afraid to sell a losing position. See, I have an ego, you have an ego, all God's children got egos. And so I come out and I say, I've done all this research, I'm going to buy XYZ. XYZ just turns around and goes in the opposite direction for whatever reason. Now, I've put my name out there. I have said XYZ is it. So I'm going to start defending why it's okay for it to go down, right? No. I bought XYZ, it's just a piece of paper. If it violates my rules, I sell it. I don't care. I was wrong. I'm not going to be right on every trade. Okay? And speaking of which, we actually know how to trade. We don't farm our money management off to other managers. We manage the money. Okay. Here's some facts. The 1929 to 1932 crash, market lost 84% of its value. For you buy and hold folks, it took 32 years for you to get back to even. Okay. 1965 to 1982, the bear market there lost 72%. Okay. Buy and hold folks took 30 years to get back to even. Now, bear in mind, this is a true statement, and you will hear a lot of money managers say this. Don't worry about the market. It always comes back. You need to have a long-term investment horizon. That's the way you need to look at investing. Do you know why they tell you that? That is not for your benefit. They tell you to have a long-term investment horizon so that you will keep paying them a fee even if the money goes way down. And they will say to you, I'll tell you a story. A few weeks ago, a new client of mine called me and he said, I was just talking to this is before he came on board, I was just talking to my money manager. And I told him, I said, you know, I'm hearing there's a lot of trouble in the world. And this is within the last couple of months. And he said, I don't know why you've got me fully invested. Don't you think we ought to pull a little of that money back and just get a little bit conservative? You've got me 100% in the market. Things could go bad. And here's what the money manager said to him. He said, Joe, you need to understand something. The reason why you pay us a fee is so that we can teach you how to be patient. Now, I'll have to admit to you that, and that's a true story, that is the worst advice I have ever heard an asset manager give to anyone. Okay? To teach you how to be patient? No. No, that's awful. I told him that. I told him that he should fire that guy, in my opinion, and he should tell him that I said it was the worst advice a money manager has ever given to any client that I ever heard of. And I said, give him my name and give him my phone number and ask him to give me a call, and I'll explain to him why I believe that. I didn't get the call. Okay? The 2002 bear market correction lost 37% of its value. It took 13 years to recover, all the way to 2013. The 2007-2009 bear market correction lost 50% of its value. It took almost 6 years for it to get back to even. Notice that the 2002 didn't recover before the 2007-2009 hit. So you've got one bear market correction coming back up, but before it got back to even, a new one hit. Okay? Now, you can listen to the big name, they've got, you'll know who they are, don't mention their names, who say, oh, you just put money in the market, buy an index. If you'd put X dollars into the market in 1950, it would be worth so many numbers of times more now. Don't worry about it. So I'm going to interpret that for you. You are not smart enough to figure out when to get into and out of the market, so don't try. That's what that's saying to you. I'm telling you, you are smart enough to do that. Okay? You don't want to waste that kind of time. All right, so here's what you're going to learn. How to always know when to be fully invested, when to be fully invested, and when to be in cash. You're going to learn how to only make money when the market is trending up and never lose money when the market is trending down. And I know what you're thinking. Well, how in the world will you know that? I'm going to show you exactly how to know that. I'm going to tell you exactly where the market is and what I'm going to do if it moves just a little bit. I'm going to tell you a little bit about that. How to be a long-term investor. This is different from having a long-term investment horizon, which is buy and hold. This is how to be a long-term investor 1 week at a time. Okay? How to triple or quadruple the market without suffering major losses. How to beat the market consistently and profitably year after year after year. So that's what you're going to learn. But first of all, you need to understand that hope is not one of the 3 steps. Now, how many of you, and you don't have to raise your hand, even the 2 people I saw raise their hand 3 times a while ago, you don't have to raise your hand on this. How many of you have bought a stock and you said, man, I hope this goes a lot higher? Who doesn't do that, right? And it goes down and you say, man, I hope it doesn't go down much more. And it goes down some more and you say, you know, if I bought some here and it turned around, I could make all that back up a lot more quickly. I hope I have that opportunity. All right, so we all know a bear market is coming. It's not a matter of if, it's a matter of when. Don't be caught long in a bear market. I'm going to show you how not to. And don't get yourself fooled into this. You're going to hear this. You hear these talking heads, it just drives me crazy when they say it. The market's going to start dropping, and they're going to say, oh, look at the value. Look at the value, okay? You want to buy value now. That's horse hockey, as we say in Texas, okay? No, you don't. Try and take value down to the grocery store and buy a gallon of milk. You want money. You want to buy here and sell here, period. Most investors buy here and sell here. I'm going to teach you how not to do that. Most investors hope that their favorite stock won't get hurt too much in a bear market. They hope they can weather a bear market. They hope the market doesn't drop too much. They hope they can hang on. Too much hope is too much risk. Don't do it. Here are the 3 steps. Realize buy and hold is a flawed, high-risk strategy destined to catastrophically fail. Quit listening to forecasts, pundits, and analysts. I can tell you what I think the market's going to do. That's worthless information. It's just a wag. Everybody know what a wag is?
A wild-ass guess.
This man deserves the prize of the day. That's exactly what it is.
Wag is a scientific.
That's right. And you'll turn on CNBC, and I'm not trying to knock anything, but you'll hear pundit after pundit try to tell you why it's good to be buying in a falling market because of value, or whatever. Don't listen to them, okay? Quit guessing about what the market's going to do and when it's going to do it. Just stop guessing. I would like to name a few names, but I'm not going to. But you have listened to them this week tell you that hell is coming. Bad things are going to happen, and because of all of the reasons that they list. They didn't give you a date certain, and they could be right. Don't put your money to work in the market based on a dadgum guess. Don't do that. You don't have to. Excuse me. Don't be afraid to sell everything and go to cash. Most people are afraid to do that. Now, for those of you who've got a stock that you have almost a zero basis in, it pays a big dividend, and you're hanging on to it because it just keeps popping that dividend out. I'm not talking about those. Hang on to those for the rest of your life. Give them to your kids when you're gone, or your grandkids, or whatever. Fine. I'm talking about that money you put in the market to grow right now. You're going to put in to grow right now. Okay? Don't be afraid to go to cash. Do not be afraid to be all in the market. Even now. Right now, I am about 93% bullish in my trades in the market. And I know right where the market is. Would you like to hear now where it is? It is exactly, before I came to this meeting, 0.6% above the trigger point of where I start going to cash. But it's not there yet. Okay? If it closes on Friday, down more than 0.6% from where it is right now, come Monday, I start not just wholesale, but I start moving to cash. Even though I'm bullish today. Okay? Realize that the market will always, that's why it's in caps, tell you when to be bullish, bearish, neutral. But you have to be able to adjust your investment strategies to the market. Buy and hold is too much risk. Value and growth investing in the next bear market will kill you. Money markets or cash won't make you any money in the next bear market. At an average of 10% a year, if the market drops 50% and comes back at 10% per year thereafter, it'll take you 7.2 years to get back to even. So you have to ask yourself, how many 7.2 years do you have left? And I don't care what age you are. You should not ever accept the fact that you're willing to throw away 7.2 years, because the odds of the next market going down 50% is pretty high. It happened in 2008, and I think the next one could be worse. But it's not a swag, that's a wag. Okay? So here are finally the 3 steps. Number 1, create 3 distinctly different investment strategies: bull bias, neutral bias, and bear bias. Okay? You need to know what they are. If someone walks up to you, like I asked you at the beginning of this session, I said, how many of you think the market is bullish? How many of you think it's bearish? How many of you, don't know? And other than the gentleman who answered all 3 of them, the point is that you need to have a strategy, just those 3. And when someone comes up to you and says, what are you doing in the market? You can say, right now I'm in my bull strategy. What does that mean? You can explain to them here in a minute. Or I'm in my neutral strategy, or I'm in my bear strategy. And you need to know what those are, and you need to know when to invoke them. Okay? Recognize that when the SPY is bullish, neutral, or bearish, and we're going to call that, for sake of argument, the market. Okay, so we're going to focus on the SPY as being the market. We could get into semantics about how it's not. It's large cap, yes, I understand that. And you can add other indexes to this strategy that I'm showing you, that if you want to have a broader view of, quote unquote, the market. But I have found this to be a really good indicator of the market. So, by the way, the market only exists in one of those three conditions at a time. It's never in two of them at the same time. Never in three of them at the same time. It is always in a bullish condition, or a bearish condition, or a neutral condition. Right now, it is in a bullish condition, 0.6% above a neutral condition. That's where it is. And here's the thing, in fact, in one of the white papers, that if you fill out the sheet that Sue's handed out to you, that you'll get from me, we'll email to you, is how to evaluate an asset manager. And one of the questions that you ask, and if you've got an asset manager, call them up, better yet, see them face to face and ask them this question. And watch their face get frozen. Ask this question: what is your sell strategy? They almost never have one. The good ones do, but they almost never have one, by and large. Always have a downside exit. You know, every position I put on, I assume is wrong. I assume that the market's going to go against me on every position that I put on. So you might say to me, well, Mike, if you're going to make that assumption, why would you even get into it? Because I don't know what the market's going to do in the future. I only know what the market's doing now. Therefore, I have to plan for a situation where the market changes course in the future. I need to have a downside exit strategy on every position, and I do. So here's an interesting chart. Well, not yet, but it will be. Here is the SPY over the last 10 years. And if you were a buy and hold person, and you bought right there on the left edge, and you held on it all the way to the top here, held on to it when it went all the way down, 50-some%, still held on, came back up to where it was, this is about a week ago when I took this shot, you would have made 61.33% over 10 years. It's not so bad. Your average annual rate of return is 4.9%. Yeah, it's better than what you get banked now, right? But you had to suffer through a 50% loss and hang on for dear life, and it took you 6+ years to get back to even. But you did, and thank goodness that bull market came in at the right time, and you did make some money. Okay? This is way too risky. And that's not very good returns. Okay? And how do I know that? Well, I've got a lot more room here on my chart. Let's see what goes there. So let's just say, for sake of argument, that all you did differently, just this one little thing, that every time that the market, that's this green line and red line, okay, every time it came down and just touched that yellow band, you just went to cash, sold everything, went to cash. That's all you did. And when the market came right back up above that little yellow band, you went all back in again. That's all you did. Just that. You went from 4-something% per year to almost 11, and from 60% gain to 176% gain. Without trying to sound overly ridiculous, which one is better? Okay? Now, you should be asking yourself, what the heck is the yellow band? Well, I could be like some people and say, well, I can't tell you that because that's our secret. So I'm going to tell you exactly what it is. Whether you ever do a penny's worth of business with me or not, you can do this. The middle of that yellow band is nothing more than a 200-day moving average of the SPY. The width of that yellow band is one standard deviation of normal volatility. So you take one standard deviation of normal volatility plus or minus above and below that 200-day moving average, and that's that yellow band. It's not magical, it's math. Okay? And right now, you see this bar here on the right? We're right there. Here's the yellow band right now. I say right now, a week ago. And here's where we are right there. So this far edge of this of the SPY is represented by this long band you see here, and we're right there above the yellow band. Does that mean that we are bearish, bullish, or neutral? What are we? We're bullish. We're above that yellow band. We don't say when it gets close we change our mind. It's got to go inside that yellow band before we change. And it has happened several times. You can see here it came up back in 2010, dropped back down into it, came back up, dropped down in 2011. But the point of it is, it tends to stay above that yellow band when it's above it. It tends to stay below it when it's below it. And it tends to tell you whether you are in a bullish cycle or a bearish cycle mathematically. Not because Mike has an opinion. This is all math. Okay? But I still got room on my chart, so I'm guessing there's something else up here. Let's see what else is up here. So let's just say, for sake of argument, and this is our, what we call our market directional index portfolio. And no, I didn't run this. I'm going to remind you, I didn't have this strategy back in 2006. I've had it for about a year and a half. This is a back test of it. But in our market directional index strategy, instead of going to cash right here, see that spot right there? Instead of going to cash, we short the SPY. And when it's in the neutral zone, now you'll notice right here's a little flat spot. That's because we're inside the neutral zone for that little amount of time right there. That's what that is. Then we pick back up on the green side. So the moment that it moves above that yellow band, we're bullish. So when it's below, like over here, let's go way over here. When it drops down here, we're shorting the SPY. That's what's happening up in here. The little flat things that you see, the little flat movements in the chart, it's when we're inside that yellow band. It's just math. Now look at the return. Now, there are a couple of assumptions on this chart, just so you know. If you're going to nail me down to particulars, I want you to know this. There's no trading fees in this. There's no fees of any kind in it, and it's assuming that I get the Friday close. Okay, so those are the assumptions. All right. But look at the difference. 283% total return. Over 14% every year. Every year. Now, ask yourself this question. Knowing full well that future returns do not equal past performance. You've heard that before, and that's true. But think about where you would be financially if you had put this strategy in place 10 years ago. I'd like to have done that. I'm doing it now. That's a great way to get my attention. I'm thinking, the screen is asking me a question.
When you set standard deviation over the middle of the yellow line, standard deviation is a percentage.
Okay, the question is what is the percentage? So I'm going to tell you how to calculate, in general, how to calculate the one standard deviation of normal volatility. And then I'm going to give you 2 or 3 places you can go to get the formula. Okay? So remember, we had the 200-day moving average, and I've said that the bandwidth is plus or minus 1 standard deviation of normal volatility. The way I calculate it is this. I use a Black-Scholes formula. I'll take the trailing 12 months of volatility, which is nothing more than the low and the high, and I forecast it forward 5 trading days. And so the Black-Scholes formula will do that, and it gives you, it takes 5 and the square root of time over the time and over the 5 days. But the point of it is, you need to go find that formula. You can look it up on Google. You can buy my book, okay? And it's in the book. The name of the book is 10, The Essential Rules for Beating the Market. It's on Amazon. It's 25 bucks. So in it, I have the exact formula, okay? But you can forget the book, although it's a great book to teach you about fundamentals and technicals. Arguably, I think it's the best book ever written. The title of the book is the number 10, okay? The Essential Rules for Beating the Market, okay? So you can do this. It's work, but you can do it. Yes, sir?
Your yellow line, help me understand, how different is that from Bollinger?
This is a great question, and it comes up almost every time I do this. And the question is, what is the difference between this yellow band and a Bollinger Band? Bollinger uses a different criteria for establishing that range. It's just different. You can chart the Bollinger across the 200-day moving average, or you can use mine. I like mine better because it is specifically tied to the volatility of the stock based upon that formula I just gave you. I'm a big believer in determining what the normal volatility is of anything I'm tracking. I do this for stocks, for ETFs, for markets, for sectors, for industries. What does it normally do? And if it exceeds that normal range, then I know what I need to be doing. If it exceeds it to the top side and I own it, I'm ecstatic. I shouldn't be, but I am, because you shouldn't be emotional about trading. If it goes against me, then if it drops below that normal range of volatility, again, projected I only go 5 days in the future. It's the same kind of calculation that options traders use to calculate what an option is going to do 3 months or 6 months into the future. All right. So this is the deal. This is what you can do. This is what you can do. This is why you do not want to do buy and hold. You want to be able to say, I'm not holding on while all this hell breaks loose on me. I'm just going to go to cash. Wouldn't you have rather gone to cash right at the top of 2007 and just sat there until it bottomed? Now, we didn't pick up. Now, here's something you're going to hear said over and over again. When you tell somebody who's a professional, or even maybe your friends, or maybe you're thinking this yourself, Mike, market timing doesn't work because no one over any long period of time has ever been able to pick tops and bottoms. That last part is true. No one has ever been able to pick tops and bottoms consistently over time. You've got to understand that's not what this is doing. This is picking a change in trend. Now, right here, see where the market came down and bottomed at March of 2009 and came back up? I'm still cash. I'm still cash. I'm still cash. All the way up here till August of 2009, I'm still cash. I completely missed the bottom. Okay? I did not get back in the market until we broke out above that neutral zone. That's what's critical about you understanding this. You cannot pick bottoms, because to do that, you would have to know the future. We don't know the future. We only know what the market is doing. I didn't know in this model, when it came back up here, that it wasn't just like right here. Came back up and fell off again. How will you know? All I know is that when you get above that neutral zone, the market tends to stay there. So the risk is inside the neutral zone. That's the riskiest time to be in the market. And if that's the riskiest time to be in the market, go to cash. Because when the market is inside that neutral zone, You don't know whether it's going to break out to the top or break out to the bottom. And if you don't know, get the hell out. Okay? This is the concept that's so important that I want you to get. And it's just math, and I have given you the exact formulas to do it.
Wait, are you talking about taxable account?
I'm sorry, sir.
Are you talking about taxable account? Let's say you have $1 million invested from taxable account, and all of a sudden you start to sell the whole portfolio, and your gain will move you in different tax brackets.
Okay, all right. All right, so I got it. So what's the tax implication of this? First of all, the real question here is, and I'm going to answer that, the real question is, how often do you change? On average, over a 10-year period, you really change about 2 times a year. So it's not a lot. But it blows the blank out of long-term capital gains. So if you're in the market, with all due respect to everyone that's in here, and I don't mean to be the least bit insulting, please don't take it that way what I say next. I never, nor do I ever recommend that you have an investment strategy designed to take advantage of long-term capital gains. It's too expensive. My job, if you're a client of mine, and nobody likes what I'm going to say next, including me, my job is to make you pay more taxes. Not just because I go to short-term capital gains. It's because I want to grow your money. I want you making a lot more money. I want you to have a higher tax profile because of that. I wish there were no taxes on it. I'd love to see a flat tax. But that's another story, okay? Yeah.
You ever find a situation like maybe we're today, I don't know if we're there or not, but where maybe the market's maybe going to turn downward, but you take a chance of something like oil because it's been so low that they continue to go up.
Okay.
You ever make those kind of exceptions?
Okay, here's the question. Do I make exceptions to this rule? Do I say because something gets all beaten up and moves way down, it is now becoming more attractive to buy? Okay? That's always there in, whether it's oil or whatever it may be, that kind of opportunity you can do. You can do that. I don't do that. That's a higher risk strategy. Listen, when we hit this next, I want you to look at me now. Here's the economy over the last, I'd like to say administration, but I won't say that. Here's the economy. Oh my gosh, they're filming this. All right. Here's the economy over the last 8 to 10 years, let's just say, okay? Here's then the stock market. Now, I want you to think about this. Forever, it has been the axiom that the stock market leads the economy by about 6 months. Therefore, you look at because everybody's all buried in these stocks and these companies and they know what they're getting ready to do and all this kind of stuff. And so the market is going to be, if it moves up, you know probably about 6 months from now that the economy is probably going to move up. And it was a good bellwether for that. Now, for the past 8 to 10 years, has that happened? It has not happened. And so what you've got is you've got a situation here. Here's the economy and here's the stock market. That difference between those two is the bubble. One of two things has got to happen. Either the economy has got to rapidly pick up, okay, and catch up with the market, or the market, which has been going like this, is going to have to correct.
So what do we have left?
I'm going to tell you, because I've got that forecasting tool I was telling you about that I did for Bloomberg, it's already forecasted the election, and the winner is to be determined. I'm not going to tell you. I can tell you who I'm voting for, but I'm not going to. Yes, sir.
I just think, as you mentioned earlier about those drawdowns and how the difference is, I think it'd be important to note if you sit still for a 50% drawdown, your next investment needs 100% gain just before you invest in it.
I'm not sure I understood your statement.
When we were talking about holding through a downturn,
Right here?
if the value of your investments takes a 50% drop, you need a 100% return return from there on, just to get that.
Yeah, I mean, that's a good point. I mean, the thing you've got to realize is this. You all know this. If you have $100 and it goes up 10%, what did you make? $10, right? If it goes up 10%. If that $100 gets cut to 50 and it goes up 10%, what did you make? $5. You made half. You don't want to ride that puppy down. That's what I'm trying to show you how to avoid. And I completely agree with you, sir. All right. So here are the steps. Step one, here's that same chart squished in a little bit. This is the market. Step one, if the market is above the neutral zone, you have a bull bias in play. If the market is inside the neutral zone, you want to be raising cash. Now, depending on the strategy that I have, and I've got 4 of them, and the 4th one's got an A and B component, so 5 altogether. In some of them, when we hit that neutral zone, I go to cash. In some of them, I tighten stops. And I start working my way out. It kind of depends on how you, but the objective is to have a go-to-cash strategy when it's inside that yellow zone. If the market is below that neutral zone, you want to have a bearish strategy. Short the market if you want to. Buy inverse ETFs if you want to. Sit on cash. At least do that. Don't get yourself caught in that next drawdown, which is going to be substantial. Okay, so here are the 3 biases. If you're bullish, you want to be 100% invested, fundamentally strong, blue chip stocks, or if you want to do the SPY, you can do that. Technically uptrending. Maintain a downside volatility-based exit. Always have an exit strategy, okay? Your objective, outperform the market in a bull market. In a neutral market, it's simple. Work your way to cash, period. Okay? In a bear market, either hold cash, you can take on a little more risk by buying some of the inverse ETFs, or, like I have in one of my strategies, we just short the market. We short the SPY. Okay? So, downside protection. Utilize a stop market on each holding, not a stop limit, but a stop limit. That should say limit, not market. Okay. Set stops 1 standard deviation of normal volatility below the previous week's lowest low. Never lower stops, unless there's a split or something like that in it. So your stops do like this. They stair step up. Okay? All right, summary. Never follow buy and hold. If you don't have that understood now, please, I hope you do. Stay unemotional, unbiased about the market. Don't love a stock. They don't love you back. Always have a downside exit strategy. Always have a bullish strategy in a bull market, a neutral strategy in a neutral market, a bear strategy in a bear market. Never base your decision on where you think the market's going to go. Quit listening to the analysts and the prognosticators and the talking heads. They haven't got a clue. They have opinions, but they don't know date certain anything's going to happen.
I heard something one time that over a period of 10 years that the market did, just by itself, did better than about 95% of the so-called guys that project where it's going.
Yeah, and this is a good point. You probably didn't hear this, but the point of it is the people who are supposed to know, when you really look at what the market's done and what they're supposed to know, rarely do they outperform. Rarely do they. I'm not going to guess about the future. I'm going to tell you what the market is doing. The word is. There's a famous person who has said, the meaning of the word is, okay? Well, is in our world is what the market is doing. Today, it is 0.60% above the neutral zone. If it closes on Friday, more than 0.6% lower than where it is right now, and it could easily do that, I am going to go from being bullish to neutral. And I'm going to do that for all of my clients. Okay? All right. So here I've got, and I think I'm out of time, so here's all of my strategies that we have. If you have got time to go to my website, turnercapitalinvestments.com, it's all explained about each of those and the differences on each one. If you have got a sheet in front of you that to fill out so you can get on my mailing list and get 2 white papers, please fill that out and turn it in to Sue at the back of the room. And if you don't have one, she can give you one back there. And You can go to, by the way, you can go to turnercapitalinvestments.com, because a lot of you are watching this online. You can go to turnercapitalinvestments.com/more-info and click on that, and you can fill out this form online, and we'll send you the 2 white papers, and if you want me to give you a call, you can do that as well. So remember this chart. Put it in your head. You can do this, okay? Thank you very much. Have a great day.
Things are going neutral.
Yeah.
You could put it down, stop.